Good evening. It's actually the morning right now. The sun's not even up, but I'm unable to be with you tonight talking about our newest project. So, what I thought I would do was at the very least just walk you guys through some of the perspectives that I have been watching over the recent months, but also about some of the details of our newest acquisition. I'm sure Parker and Ang have done a fantastic job documenting it and giving you guys the overview, but figured you would at least like to hear my perspective. This year, the world has changed. After a record setting 2019, Wall Street has been hijacked by the COVID 19 pandemic in the early part of 2020. Since February 15th of this year, the Dow has shed as much as 33% of its value at one point. Amidst a transition in the White House, the coronavirus pandemic and cases being the highest that they ever have been, and a potential new economic shutdown, it's back to pre-pandemic levels. The Dow is above 29,000. Somehow that just doesn't make sense to me. COVID-19 has exposed the vulnerability and the volatility of the traditional equity markets that are obviously struggling to stabilize in the face of this major crisis and all of the different things that are happening in the economy. With the recent volatility in the public markets, savvy investors are looking for a hedge, a shield, if you will, against the Wall Street uncertainty. Our investment strategy in commercial real estate, multifamily, it fills this demand for an alternative investment by providing access to an asset that is backed by consistent cash flow, long-term appreciation, and a hedge against inflation that is resistant to the Wall Street volatility because commercial real estate has intrinsic value. It seems that the United States has also been moving towards a renter nation, and this year has only been highlighted that fact. Homeownership has become less and less affordable since the financial crisis, despite low unemployment before a pandemic and a strong economy. But that's because the home prices have outpaced income growth by more than 2 to 1 on an annual basis. From the period between 2012 and 2017, incomes rose at a higher rate of 2% annually, while home prices rose 5% annually. More recently, for the 9 months ending in March of 2020, 14% of all homes purchased were priced at $500,000 or more. Between April of this year and June, that percentage jumped to over 25%. Since the start of COVID-19, home buyer median income is about $110,000 compared to $94,000 for pre-pandemic purchasers. So the percentage of first-time home buyers was just 31% for the year ending in 6/20, down from 33% the prior 12 months. So we're seeing an affordability problem continue to mount here in the United States, creating even more demand for multifamily housing. With that being said, let's dive into why I'm specifically excited about our newest acquisition opportunity. You may have seen an email come out named the Independence Towers. Well, that project just became the Stoneybrook Towers, and that's because we're assembling. And basically what that means to you is that the 123 units just became 171 units by adding a 48-unit garden-style property that sits directly behind the Independence Towers into this acquisition. And so I'm really excited about that because it gives us an opportunity to do multiple things that I'll talk about here shortly. But after spending what seems like countless hours reviewing our current portfolio of over 425 units in the submarket, looking at the comparables, talking to property managers, and poring over the CoStar and Yardi data, I'd like to give you my perspective, kind of where I see the opportunity on this project. And I'm sure a lot of these have already been spoken about, but maybe this will be a different way that you've heard it. The independence rental market has achieved a 3.5% annual growth rate since 2016. Historically, this property has operated above 95% occupancy. Kansas City is one of only five, well, is in the top five in the United States for markets of year-over-year rent growth, right behind Sacramento, Charlotte, Inland Empire, I think Austin, Texas, and then it's Kansas City, Missouri. That's really exciting. That's just that just speaks to our economy, our diverse economy in general. The second point being that we have a large rent cushion, which support the top rents of this market, even though we're not even close to the top rents. So as a rule of thumb, when you're evaluating the rent to income ratio, you want to see it below 30%. Well, residents within a 3-mile radius of our properties here earn an annual income or household income of $65,000, or right around $5,400 per month, making the rent to income ratio around 11%. Okay, so that's a big need, or a big point for affordability. Our pro forma rents are below the current rents on the rent roll for Independence Towers, and well below what we would call the market rents. On the Independence Towers specifically, we don't actually hit the current gross potential rents until after a full year of ownership, even with Kansas City being, again, in the top 5 nationally for year-over-year rent growth. Our pro forma NOI is $11,000 less than the current historical financials due to the above conservatism on the rent assumptions and carrying an additional $30,000 of operational expenses that is not there currently. If we were to be using true market rents from CoStar, from Yardi, from other properties, and rents in our own portfolio, we'd be adding in an additional $64,000 of top-line revenue to our GPR on this project. Let's go over to Stoneybrook now. So Stoneybrook is an interesting project. I've brokered multiple deals in Independence, and I know the price per door average is right around $53,000 for Independence submarket. So we're actually $11,000 per unit under market value, or across 48 units on this deal, $528,000 below market price. Everybody keeps talking about COVID pricing. Maybe that's the definition of it. We have a $93,000 annualized opportunity to increase top-line revenue on this property. At a 40% expense ratio, that would add $56,000 of NOI, or above around $850,000 worth of value to be realized on this project. And you have to realize that this is only a $2 million project, specifically around the Stoneybrook property. So adding close to $1 million worth of value to that is huge opportunity. 35 to 45% of those units have not been renovated, leaving us ample opportunity to add value. It's got garden style, so it's got great parking, and it has a pool. One of the last things that we can do on Stoneybrook is one of the units can be converted from a leasing office into a unit because of the opportunity to manage both properties from Independence Towers. Lastly, the supply desert. So the Independence market benefits from a stagnant supply pipeline with only 20 units being delivered within a 5-mile radius since 2004. No projects currently under construction. There's likely to be no competition, new competition in the market. So why are we combining both of these? I think there's some good points to be had here. We've talked a lot about the difference between the strategies of asset classes. You have core, core plus, value add, and opportunistic. We have a blended core plus and value add approach here. So we're combining the benefits of a stabilized asset with the power of forced appreciation through value add strategy. Simply put, we have day one cash flow and additional upside. We also have risk mitigation. So we have 2 properties here, both with strong historical performance and 2 proven strategies. Operational efficiencies. I've already spoken about that. We get to manage both properties. We can co-market as well and co-brand with shared amenities. Independence Towers, we have an opportunity to have a gym there, and Stoneybrook, we have a pool there. So there's opportunities to get really smart about the marketing of this property. We have a stronger exit strategy. So we're very confident that these 2 properties together create a more attractive package, an opportunity to increase our NOI, creating a stronger go-to-market strategy. And obviously, the larger the deal, typically the more interest you're going to get from ownership groups that are looking to purchase whenever we're looking to exit. So all in all, I hope you enjoyed the webinar. I'm sure Parker and Corey and Ang are going to give you an idea of where to head next to, but you can always reach out to me, Logan Freeman, Chief Development Officer over at FTW Investments. But just remember that private placements offer you, the investor, a tremendous opportunity to benefit financially from alternative investments offering above market risk adjusted returns uncorrelated to Wall Street. And the more and more conversations that I have with folks, that's exactly what they're looking for. Well, I hope to talk to you guys soon. Have a great rest of your evening. And until next time, I'll see you later.